So hello and good afternoon. I welcome you to today's special webinar today exclusively for JFD brokers, how to trade the market opening of the US markets. So what we want to do today is in fact have a look at a interesting development taking place right now. So if you ask me right now, I mean, it's all coming down to identifying advantages in trading and then try to capitalize on them. So it's not even a big deal if we are wrong here one or the other time, because all in all, if the expected value of our trading approach is profitable, everything should be fine. Nevertheless, I definitely have to say that I currently favor short engagements in the markets, and not only because the European markets have seen some weakness, and we want to have a look at the DAX, especially here, a market which is my main topic when it comes to trading, in fact. But also we want to have a look at the performances of the S&P 500 in this case over the last 2 trading days. So I mainly focus, in fact, on the S&P 500 instead of the Dow Jones, since once I started trading, which is quite a while ago, more than 10 years. The main market I was focusing on was the S&P, and I never really changed that. But the thing is that, in fact, even if my main asset would be the Dow Jones, we have to look, or today we should have a look at the S&P, because what the S&P delivered over the last 2 trading days was quite interesting. So we started all in all stable, and then started to sell off into the evening and into the close. And it's not just that we sold off, but it was that we closed in the region around the daily lows, which is usually a very bad sign. And with the weakness now in the US equity markets, it's no, I'm sorry, not the US equity markets, in the European markets, it's definitely the case that probably we should definitely favor short engagements. This is something we want to have a look at then a little later on. First of all, let's do some research and some advantage identification first then. So this is in fact the setup which we want to make a topic then a little later, since this webinar is taking place here between 2 to 3 p.m. GMT. That means that we won't be live anymore once the open range is final, and based on which we then can formulate our setup. Even though what we want to do is we want to formulate we want to have a look at the open range scenario from yesterday, which in fact played out really well when looking at the price action, and the market trended intraday strongly then on the downside. Based on that, you will be capable then of formulating the setup yourself. In fact, it's only 3 steps you're running through here, and it's very self-explaining, in fact. So we define the open range within a certain time span, 2:30 to 3:15 p.m. GMT. Then we look at the advantage, the overall advantage, which in fact in our case will be done via the 50-minute exponential moving average 10 here. So if we're trading above that, we're going long. If you're trading below that, we're trading short. And then we just trade the breakout of the open range and place the stop in case we are going short above the high of this defined range, respectively. Place the stop below the range once we're going long, and that's it, in fact. So very simple breakout setup. You may now say, well, does this really work in the long run here? Is this profitable? In fact, yes, it is. Also something I want to show to you a little later on. But now, first of all, let's have a look here at how things are developing in general. And at the price action. Again, here, for example, that's what happened yesterday. By the way, when the oil was triggered, you had to have to take some deep breaths here, because the thing was that we were about getting stopped out because the stop here was placed where the red line is placed right now. This is the daily high, the intraday high, and it took some time. You had to have some patience here, but finally, in the last hours of trading, then the market moved in our direction. And again, here, closed in this region around the daily lows. This is, by the way, you probably can't see it, not sure. But there you can see it. I did it slightly higher the deep blue line here, which is the closing price yesterday, 9 p.m. GMT. And the green line is the low of the day from yesterday. So I usually do this just to have an idea where we are currently trading. Also, not just in terms of the spot open, which is, by the way, marked at 2:30 p.m. GMT then here with this turquoise line. I have to draw it right now. Wait, we don't have an open, so it's somewhere in the chart. But as the market opens here in around 25 minutes, we will move this turquoise line to the region where we get to see the first tick of the trading day when the spot market opens. And so yeah, again, that's exactly what I already mentioned here. So closing in this region wasn't a good sign at all, and we closed already in the region of the lows here the day before. That was Tuesday, and we remember what happened on Tuesday. Tuesday there was the first official statement made from the new Fed chairman, Jay Powell. And Jay Powell came out quite restrictive, so making it or giving room for speculations, or he fueled speculations around the Fed probably hiking 4 times in 2018. All in all, I have to say I don't really see this as a big deal in general, because I have to say, and that's also something I mentioned during several morning meetings every day. So I'm holding these in the live stream from the YouTube channel from JFD Brokers. So if you want to take a place, participate here, just subscribe to the YouTube channel from JFD Brokers, and then you can follow these events every morning, 10:30 a.m. GMT. And what I mentioned there was that all in all, I'm not seeing such a big surprise here when the Fed is hiking rates, since market is already hiking rates 4 times in 2018, since the Fed is already expecting to hike rates minimum 3 times, and this is the majority here. And there's also a 25% chance in the Fed Watch tool. I just want to show it to you. So let me just guide you through this. So you Google Fed Watch tool, and then you guide it here to the Chicago Mercantile Exchange, CME Group. And there you have a chance to see how the market is currently seeing chances of a rate hike here. And so what you can see is that this is the current level, that currently, obviously, in March, there's nearly 100% chance. It's in fact only 86%, but it's quite unusual, let's say, that the Fed won't hike rates here. So not sure why this isn't higher right now, to be honest, because I think it's a done deal that there will be a hike. And very similar also here, what we get to see for June. So in June, the probability for another rate hike, again, you can see this here, is 3 out of 4. So nearly 75% are seeing another rate hike in June happening. So you have to add up those 2 here, and only nearly 1/4. So what you can also see here is that there will be minimum one hike nearly of 89%, 98. I'm sorry, 98%. Because you have to subtract those 2, the current levels here, from 100% to get the chances that we stay at this level here, 125 to 150 basis points in June. And so there's a 98% chance that the Fed will hike rates at least once till June. I think it will be twice. It will be one in March already, and you can keep on doing this here, and you can clearly see that also here, third rate hike is seen with a probability of over 50% here till in September then. And to be honest, if you now look at December, what you can see is that here, in fact, chances are then first time below 50%. So you can see 26% here, and here 6.4%. These are those who see 5 hikes minimum. Some of them see 6 hikes. Not sure about their optimism here, but what you can clearly see is that this is 1/3 of all market participants seeing at least a fourth hike. And in fact, yeah, this spiked higher on Tuesday, but nevertheless, we've seen a 25% chance here. And this is something I guided the attendees in the morning meetings through. We've seen this already stabilizing in the region around 25% before Powell came out with this quite hawkish statement in front of the US Congress. And by the way, he's also giving a speech there today, if I'm not mistaken. Not sure whether he can really deliver so much more, so much new, but what you can clearly see is that all in all, it's not coming with a big surprise that Powell mentioned this in front of the US Congress. What's nevertheless very surprising is to see that the market sold off sharply based on that. So that is when the statement from Powell came out, and markets started somehow around 2,785, 2,790 points, and pushed as low this day alone as 2,740, and pushed lower yesterday too. And this is, I think, due to the fact that the market is really yield sensitive right now. And I have to be honest, I'm not really sure what to make out of the current price action. What we can clearly see is that the S&P stays stable if you compare it, for example, to the European trading hours here and what the DAX is delivering. So the DAX broke out of this range. By the way, just to probably show you here, something I twittered in the morning. So I was short right from the start of the trading day, in fact. And here you can have a look at my Twitter account. And there, by the way, if you want to follow me, I think in the English-speaking trading world, it's more common to follow guys on Twitter. So in Germany, in fact, Twitter is not such a big deal, which you can also see here if you look at the followers. So I've seen guys having followers like 50,000 or so in the English-speaking community, while in Germany, Twitter is in fact not that popular. Nevertheless, I really enjoy it to sometimes tweet my thoughts here, retweet great analysis research pieces from other guys, only because it's very, yeah, it's short, it's on the point. It's not, you don't need to really go in depth here in research. While I also write in-depth research, yes, and this is published then on JFD Research, mainly, by the way, in German. So nevertheless, I highly recommend visiting our website here, jfdbrokers.com, not only to open an account, but also to, by the way, let's go here to English, to research and education. And there you can click on JFD Research. By the way, below that, you've seen that there is the events. This is where you can find all webinars taking place. And here you can see all those data. By the way, we want to leave this site open here because this is something we want to have a look at here at the PCE price index, which came in as expected, by the way. No big surprise. Probably equities would have seen some pressure already in the pre-open, now in US equities, especially if the numbers came in above expectation. But let's first of all have a look here at my thoughts around the DAX. So you can see this is in German. So sometimes it's in English, sometimes it's German. It's I'm very flexible here. But you can see here advantage short. Okay, Vorteil is advantage in English. And first target on the downside is 280-300. That was also something I mentioned. And in fact, the DAX reached that level, not just reached that level, but also broke this level, and right now, by the way, is retesting this level. So if you have a look here at the hourly chart, it's clearly something you can see here. It was a green line. So this is the hourly chart. It was a green line before, and the former resistance, even though I have to say, if you look at it from a daily perspective, I don't think that this level is so significant. Nevertheless, it can clearly be seen that there's at least 2 points or 2 times when the market tested this region. And that's why I think it made definitely sense to work out a trading range between 280-300 on the downside and 530 on the upside. And this now, this fake out above and out of this range on the upside on Monday is now, should be considered a potential fake out here. And I think with this break now, it doesn't look that promising for the DAX. And I think we have further potential on the downside. It mainly depend on the US equity market. So if I'm completely wrong with my idea on the US equity markets and there's no further pressure, I think it's no big deal for the DAX then to make it back in this trading range. And if the US equity markets can make back some of these losses here, they've seen the last 2 trading days. Nevertheless, I have to say, again, if you look at the price action, all in all, it does not look that promising. And it wouldn't come as a surprise to me if US equity markets see pressure. And now you might wonder why. Well, because the market is currently obviously still in some kind of shock, let's say, after this flash crash here at the beginning of the month, but also fearing that higher yields here and rising yields are resulting in at least a small deleveraging. So what I'm talking about is the following. Something, by the way, which is a topic for me for several years now, and something which will rather sooner or later reverse here. So what we can look at is something we call NYSE margin debt. And NYSE margin debt is free available information in the internet. So it's no big thing here to get this data and to see what happened, or what the very, very loose monetary policy, as in this case of the Fed, caused to margin debt here and the S&P. Obviously, margin debt and the S&P are strongly positively correlated to each other. So the cheap money went also, not only, but also into equities here and pushed them higher. There were huge buyback programs from companies in the US, which used the cheap money to buy back their company, if you want. And this all in all is something to be really curious about. Because now the thing is, if you're buying on margin, or if you're taking a loan and buy equities with that, and let's say it's there's a variable component in terms of the yields, in terms of yields here in this loan. Well, the thing is that as long as money is cheap, everything's fine. And you can borrow and you can see your money increasing and growing and everything's cool. But the moment the money gets expensive and equity markets see a first pullback, the one who gave you a loan probably says, you know what? I want my money back. Respectively, I want at least some insurance at your end. I want to make sure that I get my money back one or the other way. And this is then the moment when we start to talk about something we call deleveraging. And so currently, and this is one reason why we have to really fear further losses in equity markets and could see a huge acceleration here over not necessarily long term, but a midterm minimum or short term probably, because the moment markets have to sell their equity exposure here, this is like a domino effect, if you want. And this is exactly where we're standing right now. And now yields are rising while we can see that the economic growth is not as strong as it needs to be to somehow compensate for this yield level to rise. Usually you expect yields to rise once there is inflation, or a central bank to be more restrictive in the monetary policy approach, the moment when economy grows, and if people are willing to spend more, respectively, companies are doing more business because people usually have more money in their pockets, let's say, because companies can pay better money or higher salaries, and that's how you get real economic growth. The thing is that currently we don't have this. So I mean, the economic data coming from all around the world here is showing that there's economic growth, but you have to say you have to highly doubt that. For example, here in Germany, what you can see is, for example, that there's I mean, we're one of the richest countries in the world, and there's nevertheless many people out there who don't have anything. And there's a huge gap, and it's growing, this gap between the rich ones and the poor ones. And it's not only Germany, but you can see this also in other states of the Eurozone, other Euro countries. Yesterday, for example, very interesting data coming out around the inflation. So remember, by the way, let me just first of all here prepare euro area and then inflation rate. And seeing this is worrying. It's really worrying. What we get to see is scary. You see that inflation is heading lower in the Eurozone. How can this be? I mean, we are not looking here at the core inflation or something like that. No, we are looking at inflation. So energy prices, for example, which nearly doubled. Okay, that's too much, but nevertheless, we've seen a rise here of over 70% from the lows here from June 2017. So we were trading around 42 USD per barrel, and now pushed as high as 66. So this is like 24 USD. And if you divide 24, yeah, it's 57%. So it's 57% that crude oil prices rose. And now you see that Eurozone inflation is not picking up, but instead declining. That's a perfect sign of economic growth is definitely slowing. I think this is the first indication. It's not necessarily the only data you should take into account here. There are definitely other data you should take into account and into consideration here. But what you can clearly see is something's going wrong here. So this does not match, you know? And the thing is that with this slowing in economic growth, while yields are rising, chances increase that this margin debt will be rather sooner or later be aggressively reduced. That's why we have such a huge problem right now, especially in US equities, and why the upcoming months could be kind of scary to investors, let's say, especially long-term investors. So far, everything's fine in the Dow Jones. So far, we can say, well, we're trading above the 200 simple moving average. Everything's cool. The overall uptrend is still in play. If you look here, since the election of Donald Trump, we haven't traded below the 200 simple moving average anymore. It's a clear uptrend. Everything's fine. But what you can see here is an acceleration on the upside, which probably sees more like this price action, a consolidation at a higher level, with if this economic slowdown continues, plus we see a further rise in yields, well, then with a good chance that there's potentially another aggressive approach on the downside and probably attacking the region here around this 200 simple moving average. By the way, also something Jay Powell mentioned, which was a little scary. He was talking about the great outlook for the US economy and how well the US economy is doing. Look at the flattening of the US yield curve. This is usually an indication that economic growth slows down, and we are about to enter a recession here. That means nothing more than short-term yields rise because people are expecting, obviously, as already shown in the Fed Watch tool, to hike rates. But nevertheless, in the long term, 10-year yields are not rising as strong as short-term yields do because we see a softer outlook, let's say, for the US economy in this case. So this said, in combination with the words from Jay Powell, remembered me somehow quite strongly of the words used by Ben Bernanke. I think it was in 2006 when he was referring to the great US economy and how great the US did, or was it 2007? I'm not sure, but you know what happened. So 2007 with the higher volatility during summer, and then the world nearly coming to an end in 2008. So not sure whether this will happen again. I don't want to be yeah, how we say that in Germany we call this Reiter der Apokalypse. I don't know what's the English word for this. So apocalypse, obviously. It's obvious, but I'm not sure what's the English word. One second. Horseman of the apocalypse. Nevertheless, I definitely want to say that here something might cause some trouble. So with all this in mind now, there's lots of skepticism, obviously. And by the way, yesterday in the morning, so my short-term opinion switches sometimes from day to day. It just does because I am also a short-term trader, and the current sentiment in the market, the opinion of market participants, the price action changes on a daily basis. And to me, it's important to look at what currently potentially drives the markets. And yesterday in the morning, all this, what I just presented to you, is something to be scared about, definitely. Nevertheless, if everyone is scared, and let's have a look here also at the current volatility levels. It's also something worth to look at. So if you look at the VIX here in this context, so 1 second, please. So have a look here. So here, have a look at the VIX. And so what you can see is that the VIX definitely pulled back from the highs, which we marked around 1 month ago, here when we traded over 40, above 40 here, but now pulled back. Nevertheless, now we're trading back towards 20. So I want to say the following. I think that the historic average in the S&P, I have a clear number in mind, but I think it's somewhere around 20, something like 20, 15, between 15 and 20, let's say. So it's not a big deal at all if you look at this, because all in all, this is historic average. Nevertheless, if you compare this current volatility level to the volatility we've seen nearly over the whole last year and since the election of Donald Trump in November 2016, what we have clearly to state is that the market obviously starts to really fear and wants to pay more, obviously more, for insurance and to take insurance. So if I combine all this, I have to say, well, there's enough skepticism to really think that markets would potentially go higher. I mean, not that here, if such a deleveraging sets in rather sooner or later, not that I'm saying, well, that would be a potentially huge sell-off happening here, and volatility, which we've seen at the beginning of last month, respectively, volatility we've seen around the financial crisis 2008. I have to say, I don't really think that this was big, but what we get to see will be really big in terms of volatility, because now we're then starting to talk about who bails out the central banks and potentially the system, how we know it, capitalism itself. I mean, again, I don't want to be the horseman of the apocalypse, but the thing is, I mean, we don't really have a solution at hand how to solve this problem if really markets now start to aggressively deleverage. So yield levels are still at historic lows around the globe. I mean, even if the Fed now says, okay, well, there's volatility in the markets, we have to deliver more liquidity here, probably we'll cut rates again. Well, great. Well, currently we're seeing rate levels here at 125 to 1.5%, 1.25 to 1.5. Okay, now we are cutting rates, let's say to 0 again. Okay, and this will change something? I don't think so. So I mean, another opportunity is something no one wants to talk about, someone probably no one is thinking about right now, is to probably just freeze the markets. And now someone would say, hey, what do you mean? What do you mean by that? Like, freezing the markets? Well, very simple. You just don't allow any transactions in the financial markets anymore. I think this is no big deal and happened several times in the past already. Just remember when Nixon froze the gold standard in 1971. I mean, probably most of the listeners to this what I'm saying right now are too young to remember that, because they weren't even born. By the way, myself too. Nevertheless, there's still the gold standard. It's still there. Nevertheless, it's frozen since 1971. And this is an option for central banks to probably take into account here. If someone asks me what would be the solution, solution is to freeze the markets. That's what my solution looks like. I mean, there was also some small freeze, let's say, at least around the financial crisis. Probably some might remember that. I can well remember when the German finance minister came out and said, you're not allowed to sell short any companies which are trading in the financial sector, like in Germany, Allianz, for example, the big insurer. You weren't allowed to short them anymore. That was kind of a freeze. It's like you're not allowing markets to behave properly. So the thing about this, why I mention this is, So we have a great big chance to see huge volatility if this deleveraging really takes place. Nevertheless, the thing is that currently there's so much skepticism compared to what we've seen around, it's probably 3 months ago. I mean, there were times when we were here on a Thursday in this live trading session here around the market opening of the US markets. And we weren't formulating a trading setup because volatility was so low that there wasn't even an open range which was big enough to consider a trading setup, because it would have been too difficult to trade it profitably in the long term. And so it's not that long ago. And that's exactly the reason why yesterday in the morning I was like saying, hey, you know what? I think that probably there's too much skepticism, and still somehow there is too much skepticism. Why we then could probably trade higher from here instead of lower. But now the price action is definitely something to worry about. I mean, so now US markets open, by the way. I'll just have a look here. This is a daily chart in the Dow Jones. Let's have a look here at the S&P. And now I can also move here this turquoise line. Let's just see. I mean, that's, by the way, one reason why I want to formulate a trading setup after 45 minutes of trading. Main reason for that is simple, because now the market sees some really choppy and difficult to trade price action going up and down. So currently we're trading a little higher, 5 points. Now I wouldn't be surprised to see markets trading lower in the next candle, for example. And that's one reason why you want to wait till the market has stabilized. And if it then stabilizes, you're trading the break in one or the other direction here. And so now let's come back to the price action. Again, we have seen bearish price action now. And this is something, again, if the market is trading stable over the trading day, and by the way, it didn't really trade stable on Tuesday, even though at least for around 1 hour, and then started to sell off. Same happened yesterday, and it took even longer than that. You can see here pressure building from around, it was 7:15 p.m. GMT, when the market then started to sell off sharply. And if we then see such bearish closes around the daily lows, I think this is a clear sign that the market really is not just skeptic about everything taking place right now and taking and happening right now in the markets, but it's also that there is serious selling pressure still in the markets, and volatility stays at an elevated level. And this is something why I definitely favor now, 24 to 28 hours later, short engagements. And this is what my identified advantage looks like, even though there's still the possibility, and now let's move back here to the slide, there's still a possibility that we have to trade the long side. What does this mean? Well, just imagine we have now the open range between 2:30 and 3:15 p.m. GMT, and then we are trading above the 50-minute exponential moving average 10. That's when we only trade the long side then. And so we have to trade the long side, even though I have to say I'd like to reduce the position size in case of such a breakout on the long side. That's definitely something I want to mention here. And if we're trading the short side, by the way, I go with the standard setup. Let's say, let's put some numbers on this. So we're usually risking 1% of our equity. And if we're risking 1% of our equity, then I trade this 1% risk with my open range setup. If we have to trade the long side because the setup tells us to do so, we're trading above the simple moving average. Exponential moving average 10 here on a 50-minute time frame. So above this yellow line, I'm trading only 0.5%, let's say, of my equity. And in fact, that's it. Yeah. So that's what I mean when I'm talking about reducing the position size. Now let me just give you an example of how this works. So let me just guide you through this. Again, snapshot it and then just adopt it accordingly to today's trading. So we have to define the open range here between 2:30 and 3:15 p.m. GMT. Okay, so that means, and now we take the example from yesterday. So. Oh, sorry. I don't need to wait until this is okay. So now let's, by the way, It's not working the way it should. So somehow I want to have a horizontal line in this case. So now let's make this. No, probably that's not good. Let's work with blue. No, blue, we have blue already. Orange is too close to green. Well, yeah, okay, let's take this one. So now you can see here this line, and then you can see the high here. And as you can see, this is our predefined open range between 2:30 and 3:15 p.m. GMT, the high and the low here. And now what we want to do is we want to trade in direction of the identified advantage. So you can see here, for example, that the market is trading above this orange line, and then turning around, never really touching the highs here, and instead then trading lower, never triggering our setup here on the upside, but then falling below the lows. So what do we do in this case? Well, we are obviously trading below the simple, the exponential moving average 10 here on a 50-minute time frame, meaning we're trading the short side once we break out of this range on the downside, placing our stop above the highs. So then you can see the market does not really take on serious momentum here on the downside, but instead trades back, but does not touch our high. So it's a make or break approach if you want. So you're entering the market, you leave the stop here at this level, and then just see what happens. You're getting stopped out or not. If you're not getting stopped out, you take out the order at 8:50. Yeah, I have to think about it a little since it's 9:50 in Germany. It's 10 minutes before the spot market closes in the US. Then it's 9 p.m. GMT. And so, well, what we're doing here is obviously we just leave our stop at this level, and we're triggered short here, meaning we wait. We see the market moving against us sometime, but it does not touch our stop, and then it just sells off into the close here. And at 9:50 German time, so 8:50 GMT, we take out the trade. So market, in fact. So right the moment we have, in this case, it's not possible because it's a 5-minute time frame we have to look at. But nevertheless, at 9:50 p.m. German time, so 8:50 p.m. GMT, we take out the trade market. And in this case, it was somewhere here, I think, 7:20 or so yesterday. And as you can see, market yesterday, we had we got lucky here with not getting stopped out and seeing then the market moving in our direction. So you might probably say, oh yeah, he's presenting us a trading setup and it worked out yesterday. Well, what a great, what a surprise. Everyone is doing that, right? So showing a trading strategy and selling it somehow, even though I'm not selling it, but I'm showing you a trading strategy which worked out. Some of you guys probably have listened to this several times already in the past. So there have been plenty of occasions when it didn't work at all. In fact, when I started with this series here on FX Street, the first 4 times when I made this a topic, all 4 trades were losing trades. And so I definitely bet several guys listening to me back then never returned because the approach obviously didn't work. What I can tell you today is that the setup itself, if you now look at the data from the last 7 to 9 months, not sure, would show you a very nice positive equity curve. Because all in all, it comes down to trade the setup over and over again if you know it's a profitable approach. Nevertheless, you might definitely wonder, is it really profitable? Can you prove that? And yes, I can. And therefore, just let me have a look here at one of my pictures. So what's this? That's a backtest of this strategy. Simple approach. Again, as you can see here already, by the way. Oh, 1 sec. So here, what you can see here, for example, is the 10 exponential moving average. So that's an Excel sheet through which this test was run. By the way, a small anecdote here. We had this webinar around the market opening here together with Stefan Friedrichowski, a colleague of mine, a quantitative manager and a PhD in physics here. And we held this event together, I think in July, if I remember right. And so I took this screenshot because he had some trouble with his internet connections. He wanted to show to the audience that it really works out. And so I took the screenshot and now use the screenshot over and over again here to show what he worked out based on the approach, which is written down here. So this is the approach, okay? This equity curve you get if you trade this setup over and over and over again. In fact, during the time span from the 15th of November 2010 to the something like 1st of July 2017, I think. So over 7 years of data here, and we are here obviously talking about 1,347 trades done. So it's an intraday setup, even though you can also include parameters like volatility filters. So during last year, for example, as already said, there were plenty of times and occasions when we didn't have a setup, only because it's not because we don't have an open range. We have an open range every day, but we couldn't trade it because what we also need, for example, is a range which is at least 0.2% of the current index reading. So that's sad. For example, if the S&P is trading at 2,500 points, currently it's trading slightly above that, you need 0.2% open range width to then have a setup, which means you need an open range which is at least 5 points. And there were plenty of times over the last year when this wasn't the case. So probably some of you might say, well, aren't there many more trading days? Yes, but again, if you have such a filter in this, sometimes you just don't have a trade. And yeah, so what you can see is clearly rising capital and equity growth here, or equity curve, with a hit rate of 47%, and the payoff ratio, so an average gain, average profit, to an average loss of 1.3121. And this gives you an expected value. I'm doing this now all in my head. It's or I've written this down several times, so I'm not that nerdy that you now think, okay, how can you calculate these numbers? No, it's a 0.08 cents per euro risk, which means like if you have a 100,000 euro account risking 1,000 euros, it means that on average you make 80 euros per trade. So it's a positive expected value. The approach is profitable, so you can calculate this based on the input parameters. And this is the saying. Some of you might know this, okay? The trend is your friend. And what we are saying is that this pattern repeats over and over again. In fact, it's not that we invented the strategy or so, but it's a strategy which was first mentioned in an article series from a guy called Toby Crable. And there's a book. It's not a bestseller, but it's something for look for this. Yeah, let's call it real enthusiasts, respectively. It's something for assembler. Probably that's better. Some probably know that there are PDFs out there, and it's called Day Trading with Short-Term Price Patterns and Opening Range Breakout. And Crable did the following. Crable did gathered information around this open range breakout in several markets, and then wrote it down in an article series here for day traders. And so in this context, it's already known strategy in several markets, not just the S&P, but you can trade this also in the DAX, for example, in the Bund future, for example. You can do this in blue chip equities like Google, Apple. So what you obviously need is lots of volume to trade such an approach. And it's also possible to adopt it accordingly to the FX markets, for example. Like then we are talking not about the open range anymore, but we call it Asia range if you want. So you have a time of low volatility during Asian market hours. And by the way, okay, so US data disappointed. There was a market manufacturing PMI, not the ISM. This is something which we will see here in a few minutes. And it came in lower than expected. Let's just see what EURUSD is doing on that. Not reacting. Okay. By the way, let's just have a look at the DAX selling off. Love to see that. Why do I love to see that? Well, has to do with the fact that I'm in fact short. So I'm short, but it's not because of a pure discretionary approach, but I'm trading I'm managing clients' money in a managed account, and there's a systematic approach we are running here, not just on the DAX, but on several strategies. By the way, I just want to show you here the link so that you have an idea that I'm not talking. I mean, several guys know here that it's not a small account we're trading, but here you can see that's more than 400,000 right now. Asset under management and still growing. So we started out with this basket strategy we are currently using here. You can see this there, basket investor strategy. We started out around 2 weeks ago with this project here, even though I'm running this managed account already for over 1.5 years, I think. I started out in September. So what you need, therefore, to run such a project here is a company. In case of JFD, you need a company who has a portfolio management license and can give you a licensed umbrella. So you need to be licensed to offer such a managed account here. And as you can see here, this is so the overall profit so far. It's a conservative approach, by the way. So we're not running a get-rich-quick scheme here or something like that. But it's like steady. We want to produce steady return for our investors. And so far, we're doing quite well here, as you can see. So we started out with the month right today. Let's see how this works. So far, it looks good, promising. Nevertheless, you can see that's quite stable. And it's a quantitative approach. By the way, the strategy I just presented to you here on the open range breakout in the S&P, for example, is part of this basket. So it's a real basket of, I think it's 8 strategies we're running. I haven't counted it, in fact, but it's plenty of strategies, not only in the S&P, but also in currency markets. You can see all the assets traded here, for example. And yeah, one asset also is the DAX. As you can see here, it was no coincidence that I mentioned the DAX at the beginning and I said that's one of my main assets I'm trading. Well, because as you can see here, it's the major part of it. And by the way, I'm also part of this basket. So I'm not just giving my name for this, but it's also that I'm trading a strategy here within this basket. And this strategy I'm trading is currently a short. So I'm short the DAX, and I hope to make some performance here with my strategy, which then adds to the overall profitability of all other strategies. Yeah, so that's it. That's it. In fact, on the DAX and how the DAX reacted here, I have to say that I still see chances that the market will gain further momentum on the downside. And I definitely see potential down towards 12,070 to 12,100 points, but we highly depend on the US equity markets. And again, on the pressure building there. Let's just see. I mean, the opening did not look that promising. All in all, the first 50 minutes of trading weren't that promising. And again, if we are now trading below the exponential moving average 10 here on a 50-minute time frame, short engagements are to be favored. So currently, for example, the low of the day is 2,700 and 2,700.75. So that means if we are now stabilizing here, by the way, the high, let's just do the following. 1 second, please. Let's just do the following. Write it down. That makes the most sense. So here, so the current range, it's not the range we're seeing at 3:15 p.m. GMT, but the range we currently work with, if you want, and the high is 719.5. So here, now you can see that, for example, the setup would look as follows. It's the entry short at 700.75, and the stop will be placed at 719.75. Right now, 5 here. So that's in fact currently what we're doing. And why short? Well, because we are trading below this yellow line. This is the exponential moving average 10. The 50-minute time frame, and it's our trend filter. So if you're trading below that, only short engagements. If you're trading above that, only long engagements. With, in my case, then a discretionary approach, saying, okay, overall, I'm very skeptical, and there's a picture drawn by the market and the price action, which clearly shows the chances are higher that the market will sell off instead of now rising sharply. And that's one of the reasons why when we get in on the long side, I definitely want to be in with a reduced position size, since I consider the current advantage to be found on the downside. And to adopt accordingly, I can't avoid being wrong, but I can influence my performance by reducing the position size, for example. And that's exactly what I'm doing here. Yeah, so that's it. And now we have still 10 minutes to go. I'd now use this as a chance to probably guide you here through, work through the questions. Okay, so this is an interesting question, since it wasn't mentioned in any way during this webinar. Nevertheless, I think it's worth to probably make it a small topic here, since right now, obviously, no one is really talking about Bitcoins anymore. Is there a reason for that? I think yes, because it's not a one-way street anymore, and now things are getting a little difficult to make money cryptos, I think, if you're not a long-term investor here. And that's, by the way, something. Let me just give you some thoughts on the current psychology in the market. So if you look at Bitcoins here, everyone was talking about Bitcoins here. Why do I say that? Well, let's say I have a name in the German trading community, and if someone is interested, rather sooner or later, he will probably come along my name in some or the other way, because he read my book, for example, or he listened to the morning meeting, or he read some of my research articles, which are somehow everywhere in the bigger communities to be found, exclusively for JFD brokers. So in some or the other way, he probably comes along my name. And if you then go to the gym, for example, it's not unusual that especially younger guys recognize you and then come over to you and say, hey, by the way, aren't you this guy here talking about the markets every day? And then you say, yes, it's true. How can I help you? And then say, hey, but what do you think about Bitcoin? The moment everyone was asking about Bitcoin and only referring to Bitcoin, you know that this won't end well. Even though I had to say that during the morning meetings, for example, and when this squeeze happened, and I remember that day here, it was the 6th no, it was the 6th. No, I'm sorry, it was the 7th. It was the 7th, one day after Nicholas here. It was a huge squeeze. I think it was a Thursday, if I remember that right. And it was like crazy, seeing the market squeezing up from like 14,000 up to 20,000. And so in fact, I was all the time also here when the market retraced. And I mean, we're talking about retracements from like 8,000 USD here down towards 5,700. That's I mean, a corrective move of something like 25 to 30%. That's huge. And nevertheless, never had any doubts that there will be further potential on the upside. And that's usually a market environment when you know there will be a huge squeeze. And once this squeeze is over, that's usually the time to at least get more aggressive with your stop and probably get out of the position. And this is exactly what happened. So in fact, the market here saw another attack at these highs, but then sold off sharply and then kept on falling from there. So the price action itself was completely different to the times before, because when the market usually hit new highs, it really continued its strength. So, and this didn't happen anymore. And that was when, let's call it a bubble burst. But now the difference is that everyone is skeptical about Bitcoins. Everyone is now becoming an expert, at least those perma bears, let's call them, and all those experts saying, okay, Bitcoin is like a big bubble, don't trust it, it's a scam. Well, I have to say, I've read a book about Bitcoins here just to have some better idea of what we're talking about. I'm not an expert. By far not an expert, but nevertheless, I just wanted to understand the technology behind this and blockchains in general. Bitcoin, the idea behind those, let's call them cryptocurrencies, is great. It's just great, okay? And everyone calling this a scam is referring to something completely different than to the idea behind Bitcoin or blockchain technology or other great cryptocurrencies, let's put great in quotation marks, but I think the idea behind Ethereum, for example, or Cardano, for example, several reasons to be really optimistic that there's great value in it. Do we need regulation on this? Yes, probably. Nevertheless, the thing is that everyone was now jumping on this train, and that's one of the reasons now everyone becoming skeptical after everyone was optimistic in the squeeze. Why I say, well, I think there's good potential to see higher highs. And the moment, for example, Bitcoin breaks above 11,750 here, which is only 1,000 USD to go from this current level, and this can be done within one day, I think there's further room on the upside, and we could easily go back towards 15,000, probably even higher than that. So I think we're not yet done here. So yeah, that's the first thing. And for example, completely different to, completely different. In fact, it's the same, even though we're talking about a different market. One of the reasons, what I just explained here, this phenomenon, I mean, it's similar to what we've seen in the equity markets. And why I'm not that skeptical. Let's be honest. I mean, everyone is getting skeptical here. If everyone is getting skeptical, usually that's a sign that the markets will continue higher. Again, I don't hope this because I'm short currently, but nevertheless, intraday short. Nevertheless, I'm still positive. For example, in the Dow Jones here, as long over a longer time frame, as long as we're trading above the simple moving average 200, but also short term, as long as we trade above 24,600 here, 24,500, this region, I still consider it to be a good chance to favor the long side, let's say. Again, I'd really hope for a significant break on the downside again because I'm short right now. But I think you get my idea. Skepticism is usually something which is driving prices higher, while greed is something which could, potentially, in case of Bitcoin, for example, push prices higher, but then result in an even sharper drop once this, let's call, bubble bursts here. So these are my initial thoughts on Bitcoins. And now the thing is, what I'm thinking about crypto assets. Oh, I think I've answered this question already, right? So I think it's a great idea. So I think cryptocurrencies, crypto assets, whatever you call this, is a great idea, and it has definitely some potential, even though, as you already mentioned here, so we should call them currency, but they treat it more like equities by investors. This is exactly the thing, right? It's pure speculation, and I think the idea itself is something which is lost to most people out there. It's pure greed. Someone once asked me what I think about Bitcoin and where to sell it, and I said, well, if I am a real investor in Bitcoin and was invested, let's say, right from the beginning at 2012, for example, or 2011 already, and bought some Bitcoins for nothing and would be probably a billionaire today, would I sell my Bitcoins? Probably parts of it to enjoy, let's say, funny lifestyle, let's call it. Not sure if this is a fantastic lifestyle to drive a Lamborghini, but let's say it's a funny lifestyle. Nevertheless, I wouldn't sell it all. Why? Well, the thing is, if I invested in Bitcoins, it's mainly 100% because I'm 100% confident that our current system we're living in, and in this case, for example, the US dollar is, if treated the way it is, doomed to fail. So that's the same thing like buying gold. If someone is buying gold, he's not buying, or if he really is confident in buying gold and really trusts in gold, that's a clear a statement which says, I don't trust the US dollar as a store of value. It's the same with Bitcoins. And so to me, it doesn't make sense to sell all the Bitcoins then if I'm a real investor. If I'm doing this for pure speculation purposes, well then sure, I need to sell and buy and sell and buy all the time. But nevertheless, I think the idea itself is lost to most of the, let's call this investors, put them in quotation marks, it's lost to many of them. And I think long term, we have some good potential in those crypto assets in general. Nevertheless, I'm not sure whether Bitcoin will really make it. I have to say that I really love the idea behind Cardano, without going into too much detail now. But I have a friend. Yeah, let's call it friend. 1 second, please. And he's a mathematician. And so obviously mathematicians, respectively physicians, I think, yes. Someone who studies physics, for example. I mean, they are definitely those guys to talk to, and to also start deeper discussions around the sense of these blockchain technology and how to profit from it and run businesses based on them. And he mentioned Cardano to me once in a while, and that's one of the reasons why I started to really started to think about it for a little longer. And but these are only my thoughts. So it's I just hope that I could answer your question. And I just read that I 100% agree with you, which is great. So then I answered the question. And by the way, it's 3 p.m. GMT. So let's have a final look here at the equity markets. What's much appreciated, what we get to see here. Now things are getting interesting for the DAX. I mean, I definitely see this sharp drop here. I'm not sure what to make out of it, but I have to say, everything which is now trading back towards these levels, if we get to see such a stint at all, is definitely a potential short trigger. So if we can make it back above 280, 290 here in the DAX is definitely good for a run down to 12,070 to 12,100. It's not that far away. In fact, it's only 100 points, let's say. And by the way, what do we see in the S&P? Okay, S&P is still stabilizing, even though now the thing is that I would say here we have a good chance that 698 is potentially the trigger on the downside. So this could be then the short trigger. And if we're triggering here, then the setup which is presented here with the open range only has to be slightly adopted. This would be the setup then. In this case, it's 2. But yeah, so there's a potential trigger then on the short side. And let's have a look here at this next week then, if it worked out or not. I definitely keep you posted. And that's it from my end. Happy trading. Watch your stops. Talk to you again. I hope that you enjoyed this event here. Again, if you have any questions, please shoot me an email. I definitely look forward to it. And have a nice day. See you and bye-bye.